I would say it's more than fully priced in if I had to categorize what is really happening in the US markets. I mean, if you look at the year that will just about have finished, 2024, the US markets in US dollar terms have outperformed European markets by approximately 30%, which is somewhat unprecedented. And if you look at the passive funds, and if you look at the indices, global indices, the US is now a very, very large proportion of those indices. Maybe 5 years ago, it would have been closer to 50%. Now it's approaching the 70% mark. So you could imagine not just passive funds, but active managers as well, having an allocation that's even higher than that. So when it comes to discussing concentration, I think there's no doubt that there is extreme levels of concentration in people's portfolios, weighing on as in favoring the US markets.
Outside the US markets, and despite all the macro uncertainty in Europe and China, you're looking for quality names at superior valuations, specifically in those markets. It's somewhat a contrarian approach. So just help us understand the case for the names that you are convicted about, from Midea to Schneider, and how that's going to deliver alpha for clients.
Absolutely. Look, it's strange that we talk about investing in quality businesses at the right valuations, leading to a contrarian positioning. If you think about that, that shouldn't be the case. Everyone should want to invest in great quality businesses at favorable valuations, which should lead to superior outcomes in the future. What the right strategy would have been is to buy great quality companies who happen to be situated in the US and forget about the valuations. Now, not forget about them, but somewhat turn a bit of a blind eye to them. But we are strict on valuation, and that leads us to other markets like Europe and Asia, as you mentioned. So with our Asian holdings, which we've recently added to the portfolio, I would say in the last 2-3 months, we used to have very little exposure to China, but we now have well over 10% in China, and we continue to look for opportunities. We might need a little bit of help from the macro from other factors, such as the government in China introducing more fiscal stimulus. But if that were not to happen, these are still companies that have executed really well in what has been a dire situation in the Chinese market. But as I said, any stimulus which we expect to happen out of the Chinese authorities would be extremely favorable for these companies. And given their very low valuations and low positioning by global managers, we anticipate very strong returns. And we think the time is effectively now to position for this leading into the next year, given all the fear surrounding tariff wars and what have you. On a similar vein, Europe has had its share of problems. We all know how bad Europe has been from a political perspective in particular, but also from an economic perspective, which is somewhat tied to the Chinese situation. So these two things, the politics and the economics, have made investors really wary of investing anything in Europe, and that we see as great opportunities.